moment, because markets are seldom integrating climate risk into the pricing, is very difficult for the moment to run fully fledged econometric analysis, with notable exceptions, and some people in the room and in this session will show some of the cases where significant effects can be found. So let me start with the overview of the motivation that are behind this paper. So the relation between climate change and financial stability have been attracting growing attention, both in the policy discourse, talking, but also in the action. So I think I would say everything started in 2015 with the famous speech of the Governor of Bank of England. There's been more recent speeches also by members of the executive board of the ECB, European Central Bank. But then in terms of action, the G20 and through the Financial Stability Board has issued guidelines for disclosure of climate-related financial risk. That is already becoming quite practical. It's a policy action. Related to that, in 2017, the Network for Financial Regulators and Central Banks for Green Financial Systems has been created, and this is a platform where there is debate, but also debate about next actions. And examples of concrete actions: in 2018, the European Union has launched the Sustainable Finance Action Plan, which has a very important pillar on climate change mitigation. And in particular, 2 months ago, in June, the taxonomy of sustainable finance has been released, and in particular, again, that is very much focused on climate change mitigation. And so, but before I delve into the core of the paper, I just want to answer some questions, address some questions that I imagine that that may come to your mind. So first of all, why going into climate-related financial risk, in particular on economics and financial journals? So I'm very proud to be part of one of the special issues that we believe this should be probably the first on a high-ranked finance journal. I'm co-editing together with Irene Monserrat from Vienna University and with Yanis Dafermos from University of West England, actually moving very soon to SOAS. There are 12 papers under review, and we are closing now the first round of review, and we want to acknowledge the very kind support of the Joint Research Center for this special issue. Another question that might come to you, since I'm going to talk about climate stress tests. Well, I'm not sure everybody is familiar with why should we even do stress tests. So if you check on the website of the EBA, the European Banking Authority, you will read the following words. One of the responsibility of the EBA is to ensure the orderly function and integrity of financial markets, and one of the primary supervisory tools to do so is to conduct a EU-wide stress test exercise, okay? And you can find more information. Then how is this used? Then the results in particular. Well, this is one example. First of all, the stress test exercise is conducted in synergy and in coordination between the EBA, the European Systemic Risk Board, which was created in the aftermath of the 2009 crisis, the European Central Bank, of course, and the European Commission. And they are using scenarios and metrics of risk that have to be consistent with each other. And I don't want to open that door, but there would be a long discussion about the positive versus the normative function of a stress test. So at the same time, the stress test is meant to make a snapshot of the resilience of the financial stability conditional to certain scenarios, but it doesn't really mean that those scenarios have to occur or are thought to be the most likely to happen. It's more about making sure that the financial system and individual financial institutions would be resilient to to those scenarios. And now another question that may rise, since I've been talking about using network models in the paper. Well, this is my one slide about what is the motivation about using financial network models, and the next slide I will explain what they are. And let me give a bit of feedback. So I'm of a background. I've been working for 15 years in financial network models, and this is still something that many field that many economists are not familiar with. And so they're asking, okay, well, why should we care about network? What is the added value of networks? And this is my answer. So I believe that it's very clear to everyone that financial technologies play a key role in the modern economy, and they can also play a big role for big challenges. And these include financial stability, inequality, but also climate risk, as you will see, and in particular the transition to low carbon economy. Now, depending on how we use collectively, our institution use individually these financial technologies, you can support or you can the management of these challenges, or on the opposite, you could exacerbate the mismanagement of that. And financial networks are essentially, to my knowledge, that's my argument, the only way or the best way to capture the collection of unintended effects, externalities if you want, positive or negative, that arise in that process. And financial networks are if you want, you can think of something in between microeconomics and macroeconomics. In micro, you look at institutions essentially in isolation. You look at how a firm or an institution is exposed to different contracts, but you never make the link between those contracts. In macro, you aggregate all the contracts and all the institutions and all the firms into big balance sheets, but you don't look at the interaction. And network models is essentially the only discipline in town that allows to look at how things propagate through the network of financial contracts. And in particular, there are three things that can flow through these contracts. One is the exposure to risk. Another one is the impact that investment make, in particular on climate objectives. And I will explain a bit more what does it mean that you have chains of contracts. And they also impact inequality, because every financial contract comes essentially with a transfer of income and a transfer of wealth between the two parties that are coming to the contract. In a derivative, you even have three parties. That's the third party is the underlying on which the contract is written on. And more formally, a financial network is defined as a graph. Essentially, is a pair of sets. V is a set of nodes. E is a set of edges. And it's an ordered set of edges. So you have every link is an ordered pair of nodes. And there are two, so the graph can be mapped one-to-one into a matrix. That's the matrix of investments or the matrix of exposures. But a matrix that is particularly relevant is the leverage matrix, where instead of just looking at the exposure, you normalize the exposure by the capital, the amount of capital that the investor has. And that the reason of doing so is that then losses will be measured against the ability of the investor to absorb those losses. And one recent example, completely biased because it's coming from my own research of how you can use these network models, is the following. There are many others, but this is just one example that I think is relevant. We're in this paper together with other colleagues, notably including Joseph Stiglitz, and also one of the fathers of complexity, in a sense, in mathematics, Robert May. we show the following findings, that more complex networks, which means more technically, networks with a larger number of closed chains of contracts, lead at the same time to a large, under some conditions, not always, but under some conditions in the balance sheet and on the distribution of shocks on the external assets of the banks, can lead to a larger probability of a systemic default. That means a larger probability that a large or everybody in the network defaults, but also a larger uncertainty on the very measurement of that probability. And this is very interesting because it opens the way to a particular type of moral hazard, because in a more complex network, it's more difficult to anticipate what will happen. There are always measurement errors, and these measurement errors get amplified through the chain of contracts, which implies that as soon as the network becomes more complex, becomes very soon very difficult to say what will happen, conditional upon a particular shock. So this is showing you why it is so important to look into the structure of financial network. This is something that when you look at, if you take a macro view, all the balance sheet would be aggregated, you would completely miss out this very important effect. There are many others. Now let me make a transition. So recently I had the pleasure to contribute to the so-called financial impact assessment of this very important document. It will remain as important, not my contribution, but the document itself, which is 400 pages. Our contribution together with Lucia from the GRC was only 10 pages into the big thing. But this big document will remain the history of European legislation, because it's a very big step towards a low carbon economy in particular. And it has set out the criteria for technical screening and also in particular how to classify the sectors that are relevant for investment that are fostering the low carbon transition. And now sustainability today as a very important pillar on climate change mitigation, and a very important conversation is about whether this low carbon transition will happen in an orderly way or in a disorderly way. And this is why, now this leads me to the next topic, next question, which is why should we care about climate stress tests now? And let me show you here an example where the European Central Bank has recently published in its regular financial stability review this year, has included a specific it's called special feature. It's an entire section devoted to the risk that climate change can bring for financial stability. And here you see an example, one of the chart from one of the results that have been shown in this particular section, where they look at how the exposure of institutional investors towards a particular type of sectors, which is in fact it's called climate policy relevant sectors, how they have evolved over time. And it's actually very good case to mention, because this is in fact, it is based on the classification that was developed in joint work also with Irene, and that was published in 2017. And that brings me to the elaboration of scenarios. So I don't have the time to get to the conclusion too much, but I want to state what the conclusion is. Based on current available information from climate science and from the state of the economy, in particular in Europe, essentially people, both the scientific community and the policy community, but what I can make a very general argument how you can come up with essentially with these four scenarios. Here's the argument. Essentially, if we want to stay within, not even 1.5, because that objective basically is gone, but if we want to stay within the 2 degrees in terms of global warming with respect to pre-industrial times, essentially we have to undertake a profound transition to a low-carbon economy before 2030. If we don't do that, we will end up with much more severe physical risks induced by climate change. And so we are ending up in this area. And we may still do the transition, but at that point it will be too late. Now, if we instead manage to do the transition before, there are 2 main scenarios. And one is whether if we manage to do it in an orderly way, that means essentially in a way that is predictable enough for market players to anticipate price changes in all the asset classes that will be affected. Because you need to realize that low carbon transition means that you really have to change the production system of the majority of the processes in the economy. So of course there will be price changes. It's unavoidable. The question is whether this is done in an orderly way or in a disorderly way. And in fact, in an orderly way, well, essentially there wouldn't, by construction, this would be a smooth scenario, and then prices would be changing smoothly. So there isn't much to worry about. This would be a situation of a market that is perfectly foresighting policy and policymakers' intention and announcement, and this is done in a coherent way. So it's kind of an ideal world. But think what happened or what is happening these days with Brexit, and that is not always the case. That policymakers are able to implement decisions in a coherent way, and in particular in a way that doesn't have unanticipated consequences in real terms. This is why the scenario of a disorderly transition is a scenario where most people are currently focusing on. It doesn't mean that this is the scenario it doesn't mean that this is the scenario that is more likely, but because it is a scenario that we can't really exclude, and this is the scenario where big losses could occur, then of course any prudent institution or any prudent investors want to know that its portfolio will be able to withstand the losses arising in that scenario. So this is the big motivation. And then one more point. Here we're talking about 4 possible scenarios for which we are not able to attach a probability. So we need to develop, and this is what we'll briefly mention as well, a financial risk management approach under uncertainty. Uncertainty in the sense that the scenarios are not necessarily attached, they don't get attached a value of probability. You can still say maybe a broad interval, but the question becomes not what is my value at risk in the overall distribution of shocks, but it will be a conditional value at risk. I want that my value at risk in each scenario doesn't exceed a certain maximum value. In fact, this is what I've been describing in an article. This is a kind of positioning article. It's not a scientific, it's not an academic paper, but it is a positioning paper that I'm very pleased to have seen published in the Financial Stability Review of Banque de France this year. And the this is mentioned here. You see that in the table of content, first of all, this issue of the Financial Stability Review is devoted entirely to greening the financial system, and there's an entire section devoted to climate change as a financial risk. So I hope that by now I've convinced you that climate change is really on the agenda, is really on the radar of all financial supervisors. And the title of my contribution there is the importance of being forward-looking, and that's where I describe this framework to handle financial risk under uncertainty related to climate. And here it is, it's a short summary, but essentially the argument goes this way. We can imagine to have an information set, so we are taking the point of view of a prudent investor, risk-averse investor. There is an information set that consists of the set of future climate scenarios that are coming from climate science and essentially summarized by the IPCC reports. There's a second element, which are the economic trajectories, or let's say estimates or forecasts of economic or scenarios of economic trajectories under climate policy scenarios. So what are these? An example, but it's not the only one, is the set of trajectories that are produced by the so-called integrated assessment models. I don't know if you have ever heard of that, but what you need to know is that there is an entire community of environmental economists that, together with engineers in several groups in the world, have been since 20, 30 years, starting from Nordhaus, who was awarded the Nobel Prize this year, have been developing economic models of multi-sectoral models that mostly are partial or general equilibrium models or computational equilibrium models, where the economy is constantly, just to simplify, the economy is constantly on an equilibrium, on a trajectory that is consistent with a particular target in terms of emission, and it's not always the case, but ideally should also be consistent with the damages that are induced by climate change under that very same emission target. So if you go on a business as usual scenario, that means that we're heading towards, say, 4 degrees, then in that case there will be a lot of damages, but no constraint on the economy in terms of carbon tax. And then if you have a more stringent, if you start considering a more stringent target, for instance, one that would give you, would allow you to stay within 2 degrees, then the damages from climate change are much lower. And on top, there are some constraints that are coming from the carbon tax on, for instance, the prices, and in particular then the production of fossil fuels. So therefore, the output of the different sectors will be different under the different scenarios. And so these shouldn't be regarded as forecasts, but they should be regarded as consistent. So these are scenarios of economic trajectories that are internally consistent. This is how they should be regarded. And altogether, when you take sets of trajectory produced by different groups in the world, and there are about 5 or 6 major groups in the world who have been producing these trajectories, this is essentially giving you the best assessment of how an economy under climate policy could evolve in the next 20 to 30 to 40 years. Finally, there's another piece of information that would be very unwise not to use, which is, of course, the historic values of market data. But as I mentioned initially, at the moment, there is very little signal that market players are integrating climate risk in there, and therefore you can't just rely on historical values from financial markets in order to predict what will happen. We are going to face a structural break, and therefore it would be impossible or unwise or incorrect to try to predict the future from the past. Yet, there will be characteristics of firms, and institutions that will be inherited from the past, and therefore discarding entirely the information from the past would also not be a good idea. Disorderly transition, I've been describing that. And then what I need to say is, how do we construct the shocks? So one way to construct shocks that is consistent with the current way that financial supervisors are conducting the stress tests is essentially to imagine that while the economy on each trajectory is essentially in equilibrium, because of the disorderly transition, you can imagine this disorderly transition as a temporarily out of equilibrium jump from one trajectory to another that could last something between 2 to 5 years, and which would bring the economy on a different, on different levels of output by the different sectors. And therefore, finally, a risk-averse financial institution could follow the risk management strategy that consists in computing evaluate risk conditional to each of the possible jumps, each of the possible types of transitions that, that could happen. Good. So I also want to mention, before I delve into some of the more details, a bit of the relevant literature. So this paper is combining different frameworks. So it's building on the framework that Irene mentioned in the beginning, the climate stress test framework, and on the one hand, and is combining that with a framework of systemic risk in financial networks. So here you find some of the relevant literature. And so let me summarize what are the contributions of this paper. And then I'll jump directly on the results, and then I have some more details on the methodology that I can leave up for during probably the question session. So the first contribution is the following, essentially to investigate the impact on financial stability that comes from the interplay on the one hand, climate policy shocks, and on the other hand, financial market conditions. This has never been done before. Some people have been looking at, okay, what would be the impact of a particular policy shock? And then let's see the impact on a particular financial portfolios. But we show that the conditions of the financial market, in particular in terms of the general level of recovery rate on the assets that are backing up the financial contracts, as well as the volatility of the assets, plays a very important role that can change entirely the impact of the same climate policy shock. Sorry, Irene, that was a 0 or a 5? Ah, okay. So I have 0 minutes. No. Okay. So I can't see very well from far away. So I have 30 more minutes. Is that okay? Thank you. I got worried. 0 time would have been even for me. It would have been hard to improvise how to compress the remaining 30 slides. No, I'm joking. So the second contribution is to develop a graphic method to compare different trajectories, actually bundles of trajectories, and this is a picture that anticipates this approach. And then the other thing that I want to mention before, that I did mention before, is that this is in fact the first time that we combine the framework of climate stress test together with a so-called network valuation of financial assets. And I don't have the time to, this is an audience that is probably not familiar with this, but what maybe the main message you need to get is that once financial institutions enter in contract with others, in fact, there is a network of obligations. And once you have this network of obligation, the value of a claim, so if I have a claim on, say, Lucia's lent some money to me, and then she wants to know what is the value of that. Well, but if at the same time I was lending, I had another contract with Irene, and Irene has another contract with Lucia, then in fact the value of the claim, they're all interdependent because they all depend on what is our portfolio of external assets, and how that, and the correlation, and how that determine the probability that I'm actually honoring my obligation to Lucia, and Lucia is honoring the obligation to Irene, and so on and so forth in the cycle. Another contribution of this paper is the following: the majority of the stress tests that exist in the academic literature so far have been focusing on the banking sector alone. And you might be surprised to hear that, but that's the fact. So people have been working on systemic risk since the late 90s, and very much so after the financial crisis. But, well, you know how academics tend to get focused on where they can get analytical results, but essentially most of the work has been done on networks of obligation between banks. And now the problem is that, in fact, banks turn out to be not the most exposed financial actors in terms of climate-related risk. So, we're digging in the wrong place if we just look at banks. So this is why we've been extending the framework to investment funds, which turns out to be a very important actor in terms of direct exposure to sectors in the economy that are related to climate change. Think, for instance, investment funds essentially have a portfolio of equity and bonds. So all the oil companies and all the utility companies, where are they? Well, they're mostly in the portfolio of investment funds. They're not in the portfolio of banks, because the majority of the portfolio of a bank is loans to mortgages to families. And the second part is lending to other banks. And the third part is derivatives. So the equity and bonds in the real corporation, real sector corporations, is a very tiny part of the overall portfolio of banks. So this is why it's important to extend this. And finally, I just want to say it here because I won't have the time to describe the details of this, but essentially there is this framework that I've been contributing to develop. This is the Baruch et al. It's a paper that is under revision for mathematical finance, and it NEVA stands for Network Valuation of Financial Assets. So it's a framework to compute the price of a claim on another counterparty obligation when counterparties are connected in networks of financial contracts. And so this has been, it's a major step forward with respect to the previous framework of financial contagion that we were using in the previous version of the climate stress test. So a final point that I want to mention before we get into results is these two examples. As I said before, we are in a scenario of disorderly transition, and disorderly means that prices are not fully anticipated. And let me give you, I made the example of Brexit, but let me give some other examples of shocks that have real impact, which were not anticipated. So for instance, the Paris Agreement was not anticipated by most observers, and in particular by market participants. The majority of the people were forecasting a failure of the negotiation. And this is another example. Essentially, everybody was betting on Donald Trump not getting elected, and nobody would have bet on the fact that the United States would have withdrawn from the Paris Agreement, given the fact that the United States were the major proponent of the Paris Agreement 1 year before. So you see that there are, it would not be credible to think that, you can always set an economic model where you have agents that have perfect foresight capacity, but then it wouldn't be for practical use. You can do nice theorems, but in reality, market participants can be taken by surprise by policy development, and these policy developments have real consequences, real economic consequences, because these had impact on the price of certain assets in the United States economy, in particular in the sector of mining and in the sector of mining. Related to us, a very concrete situation that we're facing is that, on the one hand, the European Union has set out very concrete objectives for 2050 in terms of emissions, but it's clear that not all member states are embracing or taking that targets with the same level of engagement, let's say, or commitment. For various reasons, because they may have resources that they want to keep exploiting, like in the case of Poland. So this is now a description of the steps that are used to model the shock transmission channel in our exercise, in our analysis. So we consider a country that delays its alignment to climate targets, and this delay leads then to a if you want, late and sudden catching up. And this is precisely the scenario of disorderly alignment that the NGFS is taking very seriously. That means that there are unanticipated shocks, in particular on the market share of different type of technologies. So electricity produced from coal, well, it has to go to zero by 2050 in all the scenarios. There's no other way. And similar, the electricity produced from gas also has to reduce drastically by 2050. The European Union is even anticipating, so from 2050 is going to be, it's a reduction of 30% in terms of, the net zero is going to be for 2080. So there is a precise, if you want, schedule of reduction of emissions from in the next decades. And then this means that firms who are operating in a particular sector will be facing profits or losses that are not fully anticipated. And that means that because profitability of firms is reflected then in the value of the assets that the value of the securities that these firms are issuing, think for instance of equity, or think for instance of a bond that is issued by a firm, it's clear that a disorderly scenario will impact on the value of bonds and equity of the firms that are operating, in particular in the utility, in the primary energy, but also in other sectors that are indirectly affected. And so in order to estimate the magnitude of the shocks, the policy shock, we use these forward-looking trajectories that I mentioned before. In particular, we use the entire set of integrated assessment models. They're not the only approach, but this is it's a very well-known and established, so this is why we use it. And so this is an example of how we do this. So this is a business as usual trajectory for a particular sector. This is electricity production based on coal in a particular region, and then under a climate policy scenario, that the market share of that should drop by 2030 and even more by 2050, and that means that this is the magnitude of the shock for that sector, and then you translate that through an elasticity to the profitability of the firms, and from the profitability of the firms to the value of the securities. So I don't have time to get too much into details of that, but essentially now I want to show you a little bit the results of the, to give you a flavor of what kind of conversation you can have once you have run the exercise. And so this is a collaboration with Banco de Mexico, which has confidential supervisory data, regarding the exposure of banks, funds, across different types of contracts. Well, first of all, this is descriptive statistics. So you can see that help you read this. So the majority of the assets are held by banks in blue. Investment funds are much smaller in Mexico. That wouldn't be the case in Europe. Investment funds are roughly half of the, in terms of balance sheet size, than banks in Europe. And these are the different sectors that are most relevant in our classification for the transition. So they start from, essentially there is the energy intensive, fossil fuel, housing, and utilities. And this is now the relative weight in the two portfolios. And now this is a particular result that I use for illustration. So you have a mild scenario of transition, disorderly transition, and I want to show you what type of analysis you can run. So on the x-axis you have time, and so this time is give you the information about what happened if the shock, so if the transition happens at a particular point in time. And on the y-axis, these are the losses for the, in this case, this is for the entire Mexican financial system, but then we can also separate the analysis for banks versus investment funds. We can also do it for individual institutions. Nothing prevents that, but here we are interested because Banco de Mexico was interested in general results. This is the aggregate results. So now let's look at the different components of the chart. So the red area consists to represent the initial losses. So that means that there is a shock due to the sudden adjustment of the economy. So there will be certain assets, in particular, there's big losses on Pemex, the main oil company in Mexico, as well as utility companies that currently are still for large part producing electricity based on fossil fuel. So they would be hit. That means that the value of the bonds, the value of the equity would be hit, and this has a direct impact on the portfolio of the banks and investment funds. But this is only the first step of the story. The second step of the story is the orange area, and the orange area represents now the amplification of those losses through the interbank system, precisely because there is this network of obligations under the condition that the recovery rate on these contracts is not 1. That means that there is essentially a friction. There is a lot. You can't recover entirely the value of the contract once your counterparty is defaulting, which is usually a reasonable assumption. The question is how big is going to be the recovery, or how small is going to be the recovery. Think of, in the case of non-performing loans in the Spanish and the Italian banks, recent cases, recovery rate was 40% or 50%. Lehman was 60, 70%. So it's significantly smaller than 1. So once you have that kind of under conditional recovery rate smaller than 1, you have an amplification through the interbank system. And then the blue part, which in the case of Mexican is disproportionately big. This is a bit particular to the to the structure of the Mexican economy. This is the losses this is like the third round. So it's the round that is the contagion that is due to the common assets. So the fact that banks are exposed to assets to the same security. Investment funds are also exposed to the same security. And then you have this kind of effect that in the literature is called, well, balance sheet contagion, but it's also called due to an idea that was made popular by Kiyotaki and Moore. So essentially there is a pecuniary externality due to the fact that once there is a shock on my asset, then as a reaction I want to get rid of those assets, but by getting rid of those assets, if I do so, and particularly if many people do so simultaneously, that has a downward pressure on the price. And then everybody else who has that asset will feel poorer now because not only there was the initial shock, but now also the price has gone down. And so as a reaction, they will continue the cascade because they will also want to get rid of that same asset. And so, of course, the reason here is that because in the Mexican economy, everybody's massively exposed to the sovereign bonds, under these dynamics, you would have a massive amplification of the initial losses. And then finally, there is another area, which is the final losses that would be bore by the external creditors to the banking system, which includes money market funds and also the essentially households. Now, what I want to show you is how the interplay between the market conditions and the climate policy work out. So here, for instance, we're comparing to the left and to the right. We're considering the same market conditions characterized by these parameters R and sigma, which I can elaborate more, but essentially they capture, R captures the average recovery rate on the assets underlying the contracts, and sigma represents the volatility of asset prices. And so under the same market conditions, if over time the economy would jump to a stricter policy scenario with lower emissions, that means that, of course, the market share of certain sector has to decrease more, therefore the shock is bigger, and this is in fact what you see here, that on the, I mean, if you compare for the same point in time, which is 2030, here and here, so here the losses are larger than in the other case. So going to a stricter scenario implies bigger losses. That's what you would expect, fine. However, now, under the same market condition, so basically the message from this plot is, if the transition has to be disorderly, well, the earlier you do it, the better. Because, of course, in order to catch up with the same emission target, you'll have to make a jump, but the more you wait, the bigger will be the losses. Everything else is the same, if the market conditions are the same. And then, now we can change now the market conditions, but keeping the climate policy shock the same, so the transition the same. So here you see that if the market conditions are less risky, that means the recovery rate is higher, which is something that I can elaborate from the lessons learned from the financial crisis and what the Fed did with the mortgage-backed securities. It's something that it's a lever that policymaker can act upon very clearly, very strongly. The recovery rate. So let me unpack that a bit. So in 2008, mortgage-backed securities were used to collateralize a lot of contracts. Suddenly were worth zero, essentially. There was no market. The market was frozen, and nobody would be able to sell them. So the market value of that was essentially virtually zero. And that was a big chunk, was a significant chunk in the portfolio of banks, even larger than, or very, very significant compared to banks' capital. That implied that banks were essentially bankrupt. This is why the Fed started to have all those programs where it was purchasing. In particular, it was this purchasing program whereby it was buying mortgage-backed securities essentially at the book value, which implies essentially that they were playing on the R, the recovery rate, and they were turning on the recovery rate to 1. Okay, so this is just to give you, now we can discuss and then devils in the detail, but this is the main message. So R is a parameter where in desperate times, policymakers can dramatically act upon. And so if the market conditions are less risky, as you see on the right-hand side, then even aligning to a more stringent climate policy scenario give you less losses. So that means that you can't simply ignore the market condition and the financial stability issue if you want to do the transition. Because if you want to do the transition, you could do a transition to a more stringent scenario, to more ambitious climate goals. You can do it at a lower cost or lower risk if you set up the financial market conditions properly. So that's the message. Okay, so you see that I think it's the major contribution of this paper is to open up our mind to the fact there is not just the climate policy and it's bad for the financial system. First of all, it's not necessarily bad. Second, you need to consider the market conditions together with the magnitude of the climate policy shock. And okay, let me get to the envelope scenario. And here, this is how you can, in fact, compare different, you see, we're taking into account the uncertainty because you're looking at, on the right-hand side, these are multiple trajectories. And these multiple trajectories are characterized by ranges of the parameters for, in particular, the market conditions. So this is recovery rate within a certain range. The blue one, and then the volatility is within also within a range. And so these two scenarios, mild and stringent, you see that they are characterized by different intervals. They're actually disjoint intervals of the parameters, and they lead to disjoint set of trajectories, so which are now combined. So in this chart, essentially, you are, to my knowledge, for the first time, you're combining. You can start thinking about at the same time the market conditions and the stringency of the climate policy. Now, of course, keeping in mind that if the transition were smooth, then you don't have losses. So this is just, it's an exercise for which we are helping financial institutions to get prepared to the case of a disorderly transition, hoping, however, that this is not going to be necessarily the scenario that will materialize. And endogenously, this could also have the effect that by analyzing what are the losses in the case of a disorderly transition, this could, in fact, set out the economy endogenously on avoiding that trajectory. So there are all these endogeneity effects that have to be taken into account. So this is not a prediction. So this is it's an information of what would be it's a counterfactual result on what would be an estimate of the losses conditional upon to certain condition to materialize. Okay, so conclusions. First of all, policy implications. If the alignment cannot be avoided to be disorderly, then there is an incentive to do so as early as possible. The second implication is that you could reach a more stringent climate target if the alignment takes place earlier, and you could do so at the same cost. Okay, and then I want to discuss some of the limitations. So the first limitation that, as an economist, you may think of is that essentially there is a mechanic transmission of the shock along the chain of financial contracts that I've been describing. And well, and as it's true, at the same time, we need to take into account that this approach is, in fact, common to most modes of financial contagion in the interbank network. And as we learned from the events in the aftermath of 2008, market players are not always able to anticipate the shocks and to rebalance their balance sheet. So this idea that, because they argue, usually the argument, oh no, but this won't happen because institutions are smart and they will rebalance their balance sheet in time as soon as they see a sign yeah, but in reality, it doesn't always happen. Therefore, conducting the analysis, even under a mechanical scenario, scenario of mechanical behavior, it is useful, it is informative, and it is, in fact, the basis of all the stress tests conducted by EBA and ECB. A second limitation regards the part in which that we could discuss more if you have questions, but essentially in the when the investment fund, so the mechanism that we are using to model the fire sales of investment funds is essentially once they experience a shock, then they use a value at risk approach to determine which assets and to what extent they want to get rid of those assets. And so there are two responses to that. First of all, in fact, if you look at the prospectus of investment funds products, in many cases, that's precisely what they claim they're using. They're using a value at risk approach. So although there is not a very diffuse academic literature on that, yet this seems to be quite a reasonable assumption. And the third limitation concerns the distribution of idiosyncratic shocks that are underlying this simulation, the simulation that were used in this computation. And I don't want to get into that, but essentially, while a uniform distribution can be seen as a very unrealistic, it can also be argued that it represents an upper bound where of a class of distribution where tails are particularly important. And yeah, let me conclude. I think in terms of time, and I also want to leave a bit of time for questions. So in conclusion, this paper is one of the first time that we're presenting this around, and this will be hopefully part of this first special issue of the Journal of Financial Stability. We don't know the result of the first review yet, but the main contribution is to show that there is an interplay between climate policy shock and market conditions in order to determine what is the outcome in terms of financial stability. It's the first time that we combine the climate stress test framework, which was published on Nature Climate Change, which have, way or another, it was kind of a trigger of a number of developments, so which we are very proud of, but it was important to make more rigorous the part about the valuation or let's say the propagation of effect of price changes through the financial network, and this is what we have done in this paper. And then we think one important contribution is also that the results can be illustrated using this graphical method that gathers bundles of trajectories, and so that you can start thinking and engaging also with policymakers in having them thinking about not just the impact of the particular climate policy, but look also at the same time and what are the market conditions and what you could do on the market conditions, because as I mentioned, there are actions that can be done to at least temporarily easing the potential market financial instability through the recovery rate and through the volatility of asset prices. So I stop here, and I'm happy to take questions if there is. I hope there is still time. Thank you.